my favorite bearish strategy of all time and just how powerful it can be. So firstly, remember, before you ever enter any options trade, please make sure you know how to close it. I'll pin a video in the comment section below where I show you guys how to close out of any options trade. Now let's quickly go over our goal in the ideal situation here for today's strategy. So the goal here today is going to be able to benefit from bearish behavior in the underlying stock with a limited risk. Again, limited risk meaning that even before you enter the trade, you know exactly what your max loss is. You also know exactly what your max profit is. So the ideal situation here is you believe a stock is about to drop in price, and so you'd like to benefit from this bearish movement, because remember, we can also make money when stocks drop. I've seen a lot of people who have left the market because they think stocks are going to drop and that they can no longer make money. That's not the case. There's a lot of money to be made when stocks go down. We can make money both ways, guys. So what I'm going to do here for today's video is I'm going to be using ticker symbol AAPL, so Apple stock. So basically you want to choose a stock that, again, you're bearish on, you think is going to drop in price. So let's just pretend that I believe Apple's going to drop in price here over the next week. So I'm going to be using Apple. Remember, everything I'm going to show you here is just an example to show you guys how this strategy works and how you would set it up. So let's go ahead, and before we go into the options, remember there's two things you should always check. First thing is commission fees. We're going to be opening and closing multiple contracts here. If you're on a broker with high commission fees, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about it on here. The second thing we always need to check is we're going to be selling options here for this strategy. Anytime you sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So you should always check, does the stock have a dividend? If it does, when is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend date. If you do sell options that week, you want to close out 2 days before. So remember, we can always go to NASDAQ.com and we can search for any stock in here. So we actually have Apple right here, so I'll just click on it. And then on the left, you can click on dividend history here. And again, this will show you if the stock has a dividend, and if it does, when the ex-dividend date is. So that again, you're not getting early assigned due to the ex-dividend of a stock. So if you take a look here, Apple's ex-dividend actually just happened. It was August 5th. So you don't have to worry about it for the next week or the next 2 weeks here, okay? So always check those two things. But now that we've checked those two things, we can actually go into the options here and take a look at my favorite bearish strategy here. So the first thing I'm going to mention here, guys, is that you do not need to own 100 shares of the stock to use this strategy. That is a very common question that I get asked, so I always try to mention that in my videos. Now, the first thing you want to do here is choose a proper expiration date. And again, the idea is that the stock will drop in price prior to the expiration date. So I'm just going to leave mine as it is, September 2nd. Again, let's just pretend that I think Apple's going to drop in price from now until September 2nd. And again, I want to profit from that drop in price. So the first thing we want to do here is we're first actually going to use calls. So this strategy will involve both calls and puts. And we're going to start with calls here. So we're already filtered to calls. The first thing I want to do here is I want to try and determine what price I believe this stock will be under at expiration. So basically, I want to try and figure out at expiration, so on September 2nd, what price do I see Apple stock being under? So let's say that I think Apple stock will be below $155 on my expiration. So again, I would start by selling a call at that strike. So if I think it's going to be under $155 at my expiration, I would go ahead and start by selling a call at that strike. So I would sell a call right here. Then what I want to do is I want to switch over to buy. Now I want to buy a call along with the call that I'm selling. Now I want to buy a call with a higher strike than the strike of the call that I'm selling. So the strike of the call I'm selling is 155. So I want to buy a call with a higher strike. So up here, and I'll go ahead and buy the call at the $160 strike. So I would buy this call right here. Now this by itself is a call credit spread or a bear call spread. So remember, in the call credit spread, you put up collateral. So here you put up $500. In exchange, you receive a premium or a credit. Here it would be about around $375 or so. And then this is also a bearish strategy. So this by itself is a bearish strategy that a lot of people use. And as you can see down here, right, you would benefit from bearish movement if the price were to drop. So you'd basically be risking 120 to potentially make $380 if you were to use the call credit spread. However, right, this is not what I want to enter here. This is not what I want to do, but it's going to be very, very similar to this, right? So basically, if you take a look here, I'm not happy with the potential profit to risk ratio here. So I'm going to do something else to make this a little bit more favorable for us. So what I'm going to do now is I'm going to go ahead and come up here and I'm going to switch to puts now. Okay, so I'm going to switch to puts. Like I mentioned, this will involve both calls and puts. So again, so far, what we have is a call credit spread, which by itself is a very popular bearish strategy where you enter for a credit and you put up collateral. But again, it's not what I want. So now what I want to do here is I want to actually buy a put as well. So remember, if you buy a put by itself, that's also a bearish strategy. So I'm buying a put, which is going to be a bearish strategy, and I'm basically combining it with another bearish strategy. But here's what's nice about this. What's nice about this is what I'm going to do is, remember, for our call credit spread, we're getting paid to enter this, right? You're going to put up $500 in collateral. In exchange, you're going to get paid $375. So what we want to do here is we want to use some of this money that we're going to get paid to help us finance this put that we're going to buy now. So in other words, we want to buy a put here that's going to cost less than the credit we're receiving, because we still want to enter for a credit. We don't want to end up using any more of our own money. We want to use the money that we're going to receive for entering this call credit spread. So now I'm going to buy a put that costs less than $375. So let's just say I want to buy the put at the $155 strike, right? This is only going to be $55. So if I buy this put, it's still going to cost, we're still going to enter for a credit, which again is what we want to do ideally here. So now, as we see down here, this is still going to be a bearish strategy. But now take a look at our reward to risk ratio. So our max loss is $173, which is a little bit more than if you would have just entered the call credit spread. But now take a look at our max profit, almost $16,000. That definitely went up a lot, from $370 to now almost $16,000. So our risk went up like, $40-50. Our max profit went up by like $15,000, guys. Right? So this is why I prefer this one. And so again, you're still entering for a credit. This is still going to be a bearish strategy. And now a risk to reward, in my opinion, is a lot more favorable. So let's take a look at what this visually looks like on option strat. So remember, it's always nice to use option strat before you actually enter your trade, just to visually take a look at what your profit loss will be depending on the date, depending on the share price, depending on changes in implied volatility. So let's go to build here. And we'll just start with the basic long call here, and let's go over to Apple stock. So Apple, which is right here, and then we left our expiration as September 2nd. So again, you want to find a stock that you're bearish on, and you want to choose an expiration where you believe the stock is going to drop in price by that expiration. So remember, the first thing we did was we tried to figure out what price we believed the stock would be under at that expiration. So on September 2nd, what price do I think Apple is going to be under? I said, let's pretend that I believe it's going to be under $155. So I said, the first thing we want to do then is sell a call at that strike. If you thought Apple was going to be under $150, you would sell a call at $150. If you thought it's only going to be under $160, you would sell a call at $160. Okay, that's how it works here. That's the first step. Second step we said was, okay, now we want to come in here and you want to buy a call as well. We want to buy a call with a higher strike than the strike of the call that we're selling. So anything above 155, and I chose the one at the $160 strike. And again, you can come in here and just kind of play around, like choosing different or different strike prices and just seeing how that changes things, guys. Again, this is a really great tool. It's free and gives you the results here very quickly. So I chose the $160 strike for the call that I was buying. And I told you guys this by itself is a bear call spread, which is a bearish strategy by itself. You're entering for a credit. You basically are going to profit when the price drops. You have your max loss of 120 to potentially make $380. But again, what I don't like about this is the reward to risk, especially the fact that our max profit is capped, right? If Apple were to drop, let's say, if Apple drops 4%, you would make your max profit of 380. But if it drops twice as much, 8.3% or 8% or so, you're still only making $380, right? I don't like that. So what I said is now we're going to do one more simple thing. And again, notice how our profit and max loss are going to change here. So now I said, well, now we also want to buy put, which is also a bearish strategy, but we want to buy a put that costs less than the credit we're receiving. We want to use the credit we're receiving to finance this put that we're buying so that we're not using any extra money of our own. So I said, okay, let's go ahead and buy a put that costs less than the credit we're receiving. And I chose the one at the $155 strike because I think it's only like $55 or so. And again, this is what this ends up looking like. So again, we're still entering for a credit. Our max loss went up again by like $50, but now look at our max profit, guys. It's up over $15,000. It went from $370 to almost $16,000. So our max profit is no longer capped. And so now if we take a look here, right, if it drops 4%, like we saw earlier, let me actually go a little bit like this. So if it drops 4%, right, we're still making around the same as we would make if we had just entered the call credit spread. But now again, if it drops twice that, 8%, guess what? We end up making even more, over $1,000. We wouldn't still make $370. Now we would make over $1,000. And the more Apple drops in price here, the more you make, as you guys can see, right? So again, you basically continue to make money as long as the stock continues to fall to zero. There is no cap on your max profit. And our max loss just went up a little bit, right? It went up $50, right? I'll risk an extra $50 to potentially make, an extra $15,000 in this, particular situation. So I really love this strategy. Definitely my favorite bearish strategy to use here. Now remember, you can close out of this at any point in time, guys. So let's say Wednesday comes and Apple has dropped the 1.5%. According to this, you'd be up around $50. If you're up $50, go ahead, take your profit, close out at that point if you want. You don't have to wait until expiration. You don't have to let it expire. You can close out any point in time. Now, the other thing, of course, we always need to check is changes in implied volatility, because remember, when IV changes, it does change how this looks. So we have this slider down here, and let's see if IV starts to go down. This is what it looks like. So as you guys can see, you'll start to see more red, right? Which again makes sense because we're buying more options than we're selling here. So remember, when you buy options, you want IV to go up. When you sell options, you want IV to go down. So if IV goes up here, we should expect to see more green. And in fact, we do, right? As you can see, if IV were to go up, we start to see a lot more green, which, by the way, right, if we saw a market crash, you would start to see implied volatility rise. And if implied volatility rises here, this strategy, you would see more green. So that would also benefit you here as well, in a market crash or just a really, really, red market. So anyways, guys, if you have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.